Hello, welcome back again. A few months ago, I made a video about Okta, a very well known tech company, and back then I said that it was overvalued based on the analysis that I made. And sure enough, it actually went down a lot, and right now it's about 52% down from its 1 year high, which was $287. Now, after the stock has fallen down so much, we want to kind of re-examine it, and now I also have the tool that I have developed for the channel, and that helps me do my analysis better. I have more things to look at, and I can actually really quickly deduce a story about what's been happening with Okta, and I will let you know about it. So first things first, let's take a look at the P ratio. It's negative, so this means that the company is losing money. It has negative net income, and net income is profit. So company is actually losing money. But look at this: the price to free cash flow ratio, which is the price compared to the free cash flow that the company is making, is very high but positive. So the company is making positive free cash flow and negative net income. How is that even possible? So they are losing money in terms of their operations, and yet they are making money in terms of operating income minus capital expenditures. How is that even a thing? It's a little bit of an accounting trick, and I will let you know how this happens and why this happens as we take a look at the financial statements later. But bear in mind, this is a company that's making negative earnings and positive free cash flow. Weird. And outstanding shares that have been increasing 80%. So the company's outstanding shares were 83 million and now they are 149 million. So if you actually bought stock here, you now hold about 50% of that ownership, a little bit more like 40%, more like 60% of that ownership because of this 80% dilution here. So as you can understand, this is absolutely insane. You got massively diluted, and just this line alone would potentially prompt me to never touch this stock, at least in the next few years or so. Now, the net income, of course, as you saw, is negative, yet the free cash flow is positive, and sales are also positive. And again, we will examine the details about those. But you can actually pretty quickly understand that the company is not making money because there is no return on equity on assets, like nothing on capital employed. Company is actually losing money. But let's actually take a little bit of a closer look and understand more about the company and why these things are happening. So first things first is the revenue, it's the sales that the company is making. So the company is selling a lot. I mean, the company is selling a lot of, it's doing a good revenue, and it's increasing 62%, 53, 46. So their services are selling well, it looks like. And also making some nice gross profit here. But then as we look at the net income, you will notice here that it is negative. And actually the last fiscal year, and by the way, fiscal year, you will see 2022 here, but fiscal year is the last 12 months pretty much. And while you can see 2022, it's not the whole year, of course, it's not even over yet. So bear that in mind, it's a little bit confusing, but it's not the whole thing, it's not the whole year. And so you'll see here that the company has been losing $848 million here, with an EBITDA, and this is why EBITDA helps here. It can actually quickly tell you the earnings before interest, taxes, depreciation, and amortization is what this line means here. And you will see that the company, after all these expenses, is making 300% less net profit, less earnings basically after last year. So they actually are losing a lot more money from 2021. It's actually one of their worst years ever, it looks like. And so you'll see it also in the operating income here. And so now we know that we have negative net income here. And that's horrible because the company is not making any money, of course. Now let's take a look at the balance sheet of the company next. And typically we want to be seeing the total current liabilities of the company, the total liabilities, not current, all of those, the total liabilities of the company, and the total assets of the company, the total equity of the company. And you will see here that the total assets keep increasing, liabilities also a little bit, but the total equity of the company is very positive here. It used to be 163 million, and it's now 6 billion. And now you may be wondering, and you'd be right if you are wondering, if the company is losing money, how the hell are they making all this equity? And how they're making this equity is actually this line. So take a look at this. Additional paid-in capital. What does that mean? It means that the company issued shares. Remember? This is why a tool of that sort really helps with your analysis here. So if you go back to the stock analysis, you'll see they issued almost about as many shares as they had in 2018. 80% of those. There was an increase of 80%. And so if you go back at the balance sheet, you will see the additional paid-in capital again over here. 7 billion is what they pocketed just from selling stock to investors that probably didn't know better than to actually buy the stock at very high prices and buy a stock that's not doing very well and keeps increasing its stock its stockpile basically that is handled by investors, and so it keeps diluting you. And the same thing previous years, but this was insane over here. They really pocketed some extra because of this insane dilution. 1.6, 1.1, 700 million. Every year they're increasing their outstanding shares. So you can understand what's potentially going to happen next year, right? So the next thing, so now you know how they're making money here. And the next thing is we take a look at the cash flow statement here. So the cash from operating activities, you'll see here the net cash provided by operating activities is negative here, a little bit positive here, and then also a little bit positive here as well. And now again, you may be wondering, how does that happen when the net income is actually negative? We saw that earlier, right? The company is losing a lot of money. Take a look at this. Stock-based compensation, depreciation and amortization. Why are these things positive here? So stock-based compensation is a little bit of an accounting trick that's actually very legal, because stock-based compensation is actually extracted from net income but is added back to the free cash flow statement because it's not cash flow expenses. There's no cash extracted from the company, and so it's added back to it. And this is why you see a positive line here. And if you extract it from the net income, then you are getting a positive value here. So it actually makes this potential loss less because of this. But it is actually a cost that the company incurs because they are paying their employees using stock. And the similar thing happens with depreciation and amortization, which is added back to the free cash flow statement because it's not a cash expense. So you can understand why, now you can really understand why I like to use all these margins that I'm using in my discounted cash flow model, which we'll examine a little bit later, because I need to correlate the revenue, the net income, and the free cash flow. Because just seeing free cash flow here, you would be thinking that the company is making positive free cash flow. Yet that's very far from the truth. So you see now? And the free cash flow here, you see it's positive, right? But based on what you have seen so far, is it really positive? Of course not. So let's take a look at the stock evaluation tool now. And now you will understand why I'm using what I'm using here. First of all, I'm using the revenue growth. Why? Because it correlates with sales. It's about sales. How much is the company selling? So the company is selling about 40 to 50% more every year. This is their growth, it looks like. So we can be still a little bit conservative here and go with something like 20, 22, and 24. We're not overdoing it because the company is growing very nicely, so we're gonna go with relatively high revenue growth, even though we still want to be a little bit conservative. But now we take a look at the net income margins. What's going on here? Every year is negative. Why? Because the company is losing money. So what can you use here? If you use negative values, you're gonna get negative profit. And if you're getting negative profit from an asset, from an investment that you are holding, what exactly are you gaining from that investment, right? Because an investment is the profit that the company makes, the cash flow that the company makes. That is it for you. If you own a house, apart from the value of that house, the only thing that you can gain out of this house is the actual rent that somebody is actually willing to pay to you, the cash flow that somebody is willing to pay to you. And the same thing is with stocks, because you do not own the company, actually speaking. Now, you could say that, yeah, I have part ownership of the company, and you do, yes, but unless the company liquidates their assets, which they won't, you do not really own this. What you do own is what the company is going to be making in the future. And this is why we're using this model here. And so the net income margin is negative. What can we use here? If we use negative, we're getting negative or zero values. So I'm still going to go relatively positive here and go like 3, 5, and 7. So I'm being very confident here and saying that the company will achieve profitability at some point soon, next year, which I think is unlikely. But you understand, I want to present you with a point here. I want you to understand the whole point. And now you see why I also correlate the free cash flow margin. And the free cash flow margin is what? Is the margin of free cash flow when divided to net income, by net income. And this gives me how much of net income becomes free cash flow. Because if I'm getting free cash flow from stock-based compensation, depreciation, and all these non-cash items that are added back to free cash flow, these are actual expenses. It's an accounting trick, and I don't want that. I want my free cash flow to come from actual operations, from the operating income of the company, and not from just cooking the values between the statements, because that's what's happening in this case, for example. And it's legal. It's 100% legal. It's how it works. But many people do not recognize these things. They don't know how it works. And so, yeah, hopefully this can help you learn a few things if you are not aware about this. And so the free cash flow margin, again negative here. Some years are positive, previous years actually, but the last few years have been negative. I'm going to go with these ones and maybe use like 5, 7, and 9. Again, very, very positive here, very overconfident. I wouldn't do that myself, but I'm just doing it for this video because otherwise I would be getting values that are like negative or 0, as I said. Because again, this accounts for what the company is doing financially and not what people's perception are about the company. That's irrelevant. And so the annual return that I typically want to be making is 13%. You know that I'm using it in most videos. And when I hit calculate here, you will see that the company is not making money. And even with these assumptions here, we're looking at a company that's that cannot really hold any ground in my portfolio. I wouldn't even consider coming near this one. And yeah, you may be thinking that I'm buying this for today and in the next 10 years it's gonna be growing or so, but you are paying like 1,000 times more than what you should be actually paying, 100 times more than what you should actually be paying, and you are paying for this today. So does that really make sense? Not, I don't think so. Definitely not if you ask me. So that's what I wanted to talk about in this video, and you may be watching all sorts of YouTube videos talking to you about Okta and the fact that it's an amazing company, it's 50% down and you should be buying it because it's slow and blah blah. But all these things are just crap and they have no basis. They are just based on hype, and they just want to pump up things just because they are down in value and they are selling a lot potentially. But just selling stuff doesn't mean I'm making money. And so this is why we're going into much detail here and actually try to understand what the company is doing financially, because we're going to be investing our money here. And so we want to be making profit out of this. And in this case, that's not good. So hopefully you enjoyed the video. It helps you a little bit. I think this one was very educational. It was really worth it, I think, if you were not aware about these things, to watch it till the end. So if you did enjoy it, if you learned a few things here, please leave a like and subscribe if you're not a subscriber. At the end, at some point, I will be giving you access to this tool. I think it's amazing, and I'm still adding new things. By the way, I have just added a new module here. It's called Market Trends, and it gives you a lot of information about the currently trending tickers, and you can actually sort by all sorts of things. I think it's pretty awesome. I'm still working on these things and way more in the tool. So thank you for watching this one, and I'll see you in the next video, guys. Bye-bye.